Hello, and welcome to Donut Investment. This analysis is for macroeconomics as of 30th of July 2026. The full report is on donutcn.ca. A narrow contested and, at this run, tape-unconfirmed lead at 40%. It rests on three reinforcing legs: a re-escalated Iran oil shock, a Fed that will not cut, and the 1 August tariffs, all into cooling growth. A soft landing at 24% is the live counter case the market's own tape leaned toward. Four scenarios are always in play, and today stagflation leads at 40%, but it is a narrow, contested lead, and honesty demands admitting the tape disagreed. The Federal Reserve held rates but turned hawkish. Three officials dissented in favor of a hike, and the new projections point to a rate rise by year-end, so a September cut is off the table. Yet the market did not buy the hawkishness. The two-year yield actually fell over the meeting, the dollar softened, and gold rose. We hold stagflation in front because a re-escalated oil shock, tariff-driven inflation, and cooling growth all point that way, but we flag that the near-term tape leaned toward an easier landing. Capital is rotating toward things that hold value when inflation is sticky. The clearest inflows are into materials, utilities, industrials, and consumer staples, utilities especially, on the enormous electricity demand from AI data centers. Gold, silver, and inflation-protected bonds are bid as debasement hedges, with gold near a record-on-record central bank buying. The pressure is on the rate-sensitive corners: real estate, with the 10-year yield back near 4.5%, and long bonds under heavy government issuance. And a warning sign under the surface: a single blockbuster tech result carried the whole index higher while the average stock went nowhere, so leadership is dangerously narrow. Because the lead is narrow and the tape is contested, the sensible stance covers both cases rather than betting hard on one. Near term, respect the sticky inflation read, favor gold, defense, energy, and silver, and lean on defensive sectors like staples and healthcare, while going light on long bonds, real estate, and high-yield credit, where the mounting private credit strain sits. Longer term, hold the structural book, gold and silver on record central bank buying, and a sixth year of supply deficit. Copper and utilities on electrification and data center power demand, and inflation-protected bonds. If Iran genuinely de-escalates and the Fed pivots, the whole thing tilts back toward the soft landing. The honest risks cut both ways. The loudest is concentration. The market's top is a handful of AI megacaps making up around 40% of the index, so a reversal there is an index-wide drop rather than a tidy rotation. Armed, though breadth had been broadening until this week's blockbuster results snapped it narrow again. The oil shock is two-sided too: further escalation toward all-out war spikes energy and risk off, while a verified ceasefire would bleed the premium out and flip the lead toward a soft landing. And a slower fault line keeps building. Private credit defaults are near 6%, and funds are gating redemptions as rates stay high. So, our call on macroeconomics: stagflation. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donut Investment at donutcn.ca. The link to the full report is in the notes below. Have a great day.